What you witnessed on January 30th was not a market correction. It was not panic. It was not fear. It was a controlled paper event executed with precision to delay something far more dangerous to the system, a physical delivery failure. Silver didn't crash because people stopped believing in it. Silver crashed because too many people wanted the real thing and the system couldn't deliver. Let's slow this down step by step, because once you see the mechanics, you can't unsee them. The day the math broke. On January 30th, silver dropped roughly 40% in a single session. That headline alone is meant to shock you. But the real story isn't the price, it's the volume. On that one day, over 1.8 billion ounces of silver were traded on the COMEX. Let that sink in. That is more than 2 full years of global mine production changing hands in a matter of hours. Ask yourself one simple question. Where did that silver come from? Because it sure didn't come out of the ground. This wasn't T-selling. It was turnover here. The critical detail almost no one is talking about. Roughly 75% of those contracts were closed the same day. That's a 345% turnover rate. In plain English, positions were opened and closed almost immediately. That is not long-term selling. That is not investors exiting. That is surgical shorting. Big players dumped massive paper positions, tripped stop losses, forced margin calls, panicked leveraged traders, and then quietly bought those contracts back lower. This wasn't a liquidation. It was a price smash. Why now? Why January 30? Because March is coming. And March is a major delivery month for silver. Paper contracts are fine until someone asks for metal. That's when the game gets dangerous. The closer we moved toward March, the more open interest existed that could demand delivery, and the more obvious it became there's not enough registered silver to satisfy even a modest increase in physical demand, so the price had to be smashed, not to reflect reality, but to discourage delivery. The Fed chair announcement. Perfect cover. Every operation needs a headline. This one got a gift. The announcement of Kevin Warsh as a potential Fed chair was used as the narrative trigger. Stronger dollar, higher rates. Volcker 2.0. Markets were told, this changes everything, but it doesn't. And we'll get to why later. For now, understand this. The announcement didn't cause the crash. It provided cover for it. While paper collapsed, physical did the opposite. Here's where the story completely breaks. While paper silver was collapsing, physical demand exploded. SD Bullion reported sales 2.5 times higher than their previous all-time record. Not last year. Ever. One single day generated more revenue than some entire months in 2025. That is not fear. That is conviction. Mints are breaking under the strain. Sovereign mints are overwhelmed. The Perth Mint, others across the globe, delivery timelines have stretched from 2 to 3 weeks to 8 to 10 weeks. Some mints have shut down new orders entirely, not because demand disappeared, but because they can't source enough blanks. That's the physical market. And it's telling a completely different story than the paper price. The smoking gun. Price divergence. Let's talk about Shanghai. While Western paper silver dropped near $80, Shanghai physical prices held near $100. That's a 25% premium. In a global commodity market, that should never exist unless the system is broken. This isn't arbitrage noise. This is physical reality refusing to follow paper fiction. The delivery math. Nobody wants you to do COMEX registered silver, the metal actually available for delivery, sits around 104 million ounces. That's it. On crash day, 1.8 billion ounces were traded. If even a small percentage of remaining March contracts stand for delivery, there isn't enough silver, not even close, and that's why this happened. This wasn't T about price. It was about time. The goal wasn't T to end the bull market. It was to buy time, time to shake out leverage, time to scare retail, time to reduce delivery risk, because you can smash a paper price, but you can't conjure metal. And that's where this story is heading. In part 2, we're going to cover why the Volcker fantasy doesn't T-work, why this correction fits historic bull markets perfectly, why leverage is being deliberately destroyed, and why physical silver, not paper, decides how this ends. Because the real question isn't T if physical wins. It's when. Now let's address the story they want you to believe. That this crash happened because a new Fed chair means a return to Paul Volcker. That rates are going to surge. That inflation will be crushed. That silver's fundamentals are suddenly invalid. This is fantasy. Dangerous fantasy. The Volcker myth. Why it can't happen. In 1980, when Paul Volcker raised rates above 15%, U.S. debt to GDP was roughly 30%. Today, it's over 125%. Back then, the U.S. wasn't adding $1 trillion of new debt every 90 days. Today, it is. Back then, higher rates hurt, but didn't break the system. Today, sustained Volcker-style rates would collapse treasury markets. destroy government financing, blow up banks, freeze housing, and detonate derivatives. The math does not allow it. Not politically, not financially, not structurally. So when markets sold silver on Volcker fears, they weren't reacting to reality, they were reacting to narrative. And narratives are tools. What really changed? Nothing that matters. Let us review what did not change. Global silver supply is still in a 5-year cumulative deficit industrial demand from EVs. Solar, defense, and AI is still accelerating. China, export controls are still in place. Governments are still stockpiling strategic minerals. And silver is still being consumed permanently, not recycled. You can rate hike your way out of a physical shortage. You can't narrative your way out of depleted inventories. And you can't margin call reality. This is why volatility is now extreme. This market has become a meat grinder for leverage, margin hikes, violent intraday swings, sudden liquidity vacuums. That's not accidental, it's deliberate. Because leverage threatens delivery, and delivery threatens the system. If you're trading paper silver on margin, you're playing on a battlefield designed to remove you. That's why the message is simple. This is not a market for leverage. This is a market for custody. History is clear. This is normal in real bull markets. Let's zoom out. In the 1970s, gold bull market, gold fell 47% in 1974 before rising 734% into the 1980 peak. Corrections didn't end the bull, they reset it. What we just saw in silver isn't extreme in historical terms, it's modest. What is extreme is the physical backdrop behind it. The core truth they can truwak. To escape. Here is the reality no paper market can fix. You cannot cure a massive physical shortage by selling imaginary metal. Paper can dictate price short term. Physical dictates outcome long term, always. Every ounce sold on COMEX still has to exist somewhere, and increasingly, it doesn't. This is why the divergence can last. We now live in a split market. One price for contracts, another price for metal. That gap is not stable. It resolves violently every single time. Either paper rises to meet physical, or the paper market loses credibility entirely. There is no third option. The final takeaway. This crash wasn't a signal of weakness. It was a signal of desperation. They wouldn't need this level of force if the system were healthy. They wouldn't dump 2 years of supply in hours if inventories were plentiful. They wouldn't smash the price if delivery wasn't a threat. The message isn't to panic. The message isn't to chase. The message is to understand. Because in markets like this, if you don't hold it, you don't own it. Custody is king. Paper can be liquidated. Margins can be raised. Rules can change overnight. But physical metal? It answers to no margin clerk. This divergence will end. And when it does, it won't be subtle. Stay grounded. Avoid leverage. Do your own due diligence. Because reality is already winning. The paper price just hasn't caught up yet.